Just a year ago, I was working a 9 to 5 job, grinding my way climbing the corporate ladder and wondering if I would ever achieve financial freedom. My life changed when I made the decision to take control of my finances and commit to learning how to invest. Now, it wasn't an overnight success. I made a lot of mistakes, learned the hard way, and stayed consistent. Welcome to another Economics video. I am a full-time investor and educator dedicated to making content that simplifies investing and help you stay informed about the latest trends in the world of finance. In this video, I'm going to be sharing 5 important lessons that I've learned over the past 10 years of investing. Investing is not a get-rich-quick scheme, but it can be simplified if you understand the key principles and filter out all the noise that you don't need. Whether you're just starting out or investing for a while, these 5 rules are important to know as you prepare to grow or rebalance your portfolio for the new year. Rule number 1, avoid the hype and stay calm in market downturns. One of the biggest mistakes that new investors make is letting emotions like fear or greed drive their decision. If you want to succeed in the long run, you need to learn how to avoid chasing the hype and how to stay calm when the market goes through tough times. These 2 habits are crucial for building a strong and resilient portfolio. Here's a real investment that I made in 2024 when CrowdStrike was making major news headlines causing an outage of impacting millions of computers, rendering hospitals, airlines, and banks useless, causing the stock to drop as much as 28%. But I saw this as an opportunity. After digging into their financials, I found out that they had an annual recurring revenue or ARR of $3.65 billion, meaning that most of their clients' contracts are on an annual basis. So it's not like these clients could have just stopped using CrowdStrike's service. In addition to 65% of their customers using 5 or more of their products, 44% of their customers using 6 or more of their products, and 28% of their customers using 7 or more of their products. So, as you can see, clients who adopt multiple products are less likely to switch due to deep integrations of tools and complexity of switching. This is reflected in their most recent earnings call, stating that their gross retention declined less than 0.5%, coming in at 97%. So, my thesis was right. Most clients stayed and not much has changed, but yet it didn't really justify a nearly 30% drop in its market cap, wiping out $20 billion. I saw this as an opportunity to buy at a heavy discount. So downturns are not disasters, they are opportunities. If you agree, give this video a like. When markets drop, a lot of people panic and sell their investments at a loss. Don't be that person. Remember what Warren Buffett said: be fearful when others are greedy and be greedy when others are fearful. When the market is down, that's oftentimes the best time to buy high quality assets at a discount. Market downturns are a natural part of investing. These downturns happen all the time and they will continue to happen. Whenever you're in doubt, zoom out. Look at the bigger picture. Look at the long term. The stock market has consistently trended upwards despite short term dips. Sell out of fear will only lock in those losses and prevent you from benefiting when the market rebounds. On the other hand, it is very important for investors to avoid the shiniest object. It's easy to get caught up on the incitement of all the hot sectors and trending stocks. You hear everyone talk about electric vehicles, quantum computing, or the next big AI company, and you think that you need to get in on those before it's too late. But here's the truth. If you're hearing about it everywhere at dinner parties, group chats, colleagues, it's probably too late to buy. By the time the sector or stock becomes your Uber driver's small talk, much of the growth has already been priced in, and the risk of losing money really increases. Instead, focus on investments with strong fundamentals and long term potential. Look at companies with solid financials, a proven track record, and competitive edge in their industries. These are the types of investments that will continue to grow steadily over time, not just ride a temporary wave of hype. To manage your emotions during these moments, it helps to stick to a long term plan. Rule number 2, assess your financial situation before you invest. It's the beginning of the new year and you're ready to start taking investing more seriously. But before you even think about investing, you need to take a step back and assess your current financial situation. This is something that a lot of beginners skip, and trust me, it's one of the biggest mistakes that you can make. If you've been investing for a while, now is a good time to reassess your budget, your income, and your expenses. Remember, investing is not a quick fix for financial problems. If you don't have a solid financial foundation, you're going to end up panicking when the market takes a dip, or even worse, needing to sell your investments to cover your emergencies. And that's why this first step is so important. This gives you peace of mind so you can focus on long term growth. Start by building your emergency fund. That's the cash that you set aside to cover at least 6 months of living expenses. Think of it as your safety net. If you lose your main source of income, you won't have to sell your investments or go into debt. If you don't have enough for your emergency funds, here's a pro tip. Don't just stash your cash underneath your mattress, put it in a high yield savings account. These accounts offer interest rates that are way higher and better than regular savings accounts. So your money generates more money at a faster rate. I have a list of high yield savings accounts that you could choose from to get upwards of 4.5%, which is amongst the highest on the market right now. The link is in the description of this video. Once you get your emergency fund sorted out, the next step is to figure out how much excess capital you have to invest. This is the money that is truly extra after you paid all your bills, set aside for emergencies, or even maybe saved aside for short-term goals like a new car or vacation. The golden rule of investing is to only invest money that you won't need in the short term. Investing is a long-term game, so if you're pulling out money only after a few months, you're probably not giving your investments enough time to grow. And the last thing you want is to sell at a loss and watch the price go up after you sell it. So at the start of this year, please plan your budget wisely if you haven't done so already. Consider it your due diligence to set you up for success in the new year. Once you know how much extra money you have, decide how much of it you want to allocate to investing in each month. This is where discipline comes in. Start with an amount that is comfortable and sustainable for you. $100 or $500 a month, whatever fits your budget. Pick an amount that you can consistently contribute to your investment account. And if you're thinking, Eric, I don't have much money to start investing, don't worry. The amount matters less than the habit itself. Start with $10, $5 per month, whatever it might be. Any amount that you decide based on your budget is a good amount to begin with for you. Discipline and consistency will give you the confidence that you need. When you know you're not putting your rent money or emergency funds at risk, you can invest with a calm, long term mindset. Rule number three, continuously learn and practice with paper trading. Investing is not a skill that you learn once and master completely forever. It's a long term journey of continuous learning. Whether you're brand new or have already some experience, staying curious and consistently improving your knowledge is what separates the successful investors apart from the rest. For beginners, the most important step is to understand foundational concepts of investing. For example, what is compounding and how does it grow your wealth over time? How do you diversify and how do you protect your portfolio? How do you pick the right stocks? These concepts are the building blocks of your investing journey. You don't need to learn everything all at once, but you do need to start somewhere. Read books, watch videos, or take structured courses that explains these topics in an easy to follow way. The goal is to build a strong foundation by learning from experienced investors, so you can internalize and learn and make informed decisions independently. Learn from the right resources is key, but putting what you learned into practice is even more important. The best way to put your knowledge into action is actually practicing with paper trading accounts. These are simulated environments where you can try out investment strategies, make trades, and see how the market works without risking real actual money. Paper trading is especially valuable for testing out new concepts. Not having enough money is not an excuse to delay your investing journey. Anyone can open up a paper trading account and gain experience by buying stocks and ETFs. The key is to treat paper trading seriously. Follow the same disciplines as if it were real money. You want to use paper trading to understand yourself. What would you do when the stock is falling? How would you go about allocating your capital? And how do you handle emotions like fear and greed? For me, paper trading was a game changer when I was starting out. I used to test out different strategies, understand how the market worked, and experience the ups and downs of investing without really having to risk my real capital. It gave me the confidence to move into real investing when I was completely ready. Even as you grow as an investor, continuously learning and practicing remains essential. The market is always evolving, and so should you. Stay curious about trends, industries, strategies, read the market news, dive into companies' reports, and reflect on your past trades and what worked and what didn't and why. The combination of these learnings and practices builds consistency that all successful investors rely on. No one is perfect at the start, but a good investor keeps adapting, showing up every day to stay intact and stay hungry for new opportunities. Once you've mastered this habit, you'll be ready to start automating your investments and growing your wealth, which brings us to rule number four. Rule number four: automate your investments with dollar cost averaging, or DCA for short. Consistency is one of the most powerful habits of investing, and automation is the best way to ensure you stay consistent. For many beginners, even seasoned investors, emotions can get in the way of rational decisions. And that's where dollar cost averaging, or DCA for short, comes in. DCA is an investment strategy where you invest a fixed amount of money at regular intervals, regardless if the market goes up or down. For example, you might want to invest $100 every week or $500 every month into a stock, ETF, or index funds. This removes the guesswork of trying to time the market, which, let's face it, is nearly impossible even for professionals. So, why is DCA so effective? When you DCA, you're automatically buying shares when the prices are low and fewer shares when the prices are high. And over time, this helps you average out your cost basis and reduce the impact of market volatility on your portfolio. It's a simple yet incredibly powerful way to build wealth consistently. Automation is key here. Most investing platforms allow you to set up reoccurring investments. This means that you don't have to remember to manually buy every single month or worry about missing an opportunity. Once you set up your DCA plan, it'll run on autopilot, set it, and forget it. Let me share an example of my own journey. When I was starting out, I set up DCA for ETFs like the S&P 500, like SPY, and the Nasdaq 100, like QQQ. These are long-term bullish assets that represents some of the largest and most stable companies in the world. I didn't have to worry about whether the market was up or down because my investments were happening automatically every single month. Fast forward to today, and that strategy has paid off in a big way. And if you're just starting, think of DCA as your best friend of investing. It helps you build the habit of investing regularly and remove the emotions of the ups and downs that come with watching the market. And you don't have to check the stock price every single day or panic when the market is dipping. With DCA, you're playing the long game. With DCA, it isn't just for beginners. Even experienced investors use it to maintain discipline and balance their portfolios. For example, if you're investing in high growth sectors like tech or renewable energy, DCA can help you spread out your risk over time instead of going all in at once. The beauty of DCA is that it works for any budget, whether you're starting out with $50 a month or $5,000 a month. The principle remains the same. The key is to start small, stay consistent, and let time and compounding do the heavy lifting for you. So, if you're someone who struggles with consistency, or if you've ever felt paralyzed by the fear of buying at the wrong time, DCA is the solution that you've been looking for. It's a strategy that works for everybody, no matter your experience level. Once you set up your DCA plan, the next step is to focus on building a balanced portfolio, one that aligns with your goals and risk tolerance. Rule number five: stay informed and observe your surroundings. One of the most underrated skills in investing is learning how to pay attention to the world around you. Oftentimes, the best investment opportunities are hiding in plain sight, right in your daily life or products that you use every single day. Think about the brands or services that you use every single day. Is there a grocery store that keeps expanding to new locations? Is there a bank that provides great financial services to you, or an essential mobile app that you use every single day and you can't live without? These are the companies that are shaping your habits quietly and potentially the habits of millions of others. Another way to spot trends is by paying attention to what's happening around the world. The economy, global events, even pop culture can influence markets. For instance, during the pandemic, many investors were noticing a rise of remote work. That led to the huge growth of companies of like Zoom or DocuSign, and even cloud computing giants like Microsoft. The key is to stay curious and observant at the same time. When you hear about a new product or a technology, ask yourself, who's behind this? How big is the potential market? Could this change the way that people live or work? You also need to stay informed about broader macro trends and news. You could simply do this by following reputable news sources to stay updated on global events, economic changes, or even industry shifts. You could follow them on social media or sign up for their free newsletter, like the one that I send out every single Sunday. It's free to sign up, and you know where the link is. Investing is about connecting the dots. The more informed you are, the better equipped you'll be to spot opportunities before they become mainstream. But remember, being observant doesn't mean you're jumping on every single trend that you see. Combine what you notice in your daily life with solid research, look at company financials, leaderships, and long term potential before making a decision. I hope that these 5 investing rules is going to help you reconsider your approach to investing if you're new to the markets. And if you're an experienced investor, let me know in the comments your top investing rules or share some of the lessons that you've learned along your way. I'm always looking forward to reading your thoughts and questions. And don't forget to sign up for my free investing newsletter. You'll get my weekly stocks that I'm watching, market updates, free PDF guides, and exclusive deals for my subscribers. And if you're looking for daily investing guidance for stocks, options, cryptos, check out my private investing community. This is where I provide real time guidance, buys and sell updates, as well as my structured investing course. See you in the next video.